Once again, you're welcome to today's webinar titled Trading the Australian Dollar. Before I go deep into this, I'd like to also mention that the Australian dollar is one of the major currencies that we trade in the markets. There are about 8 of the major currencies that we trade. We have the US dollar, we have the euro, we have the British pound, we have the Canadian dollar, we have the New Zealand dollar, we have the Japanese yen, we have the Swiss franc, and we have the Australian dollar. Today, we are focusing on the Australian dollar. The reason why it's important that we look into this and understand exactly things that we need to know around these assets is if you're going to trade an asset profitably, it's important to understand what it even represents, important to understand the factors that drive it, the key information that you need to know so that when you're trading you can also factor these things in and we can also walk through with how to make better or more informed decisions. Imagine you're just trading a currency and you don't understand the factors that drive it. It becomes difficult for you to find quality trade ideas in line with these factors. It becomes difficult, right? You want to trade, the AUD can be a very interesting currency to trade. One of my favorites actually, and it's because it tends to move quite clearly. Policies are somewhat stable, right? The factors are easy to spot, right? And we're going to go into all of these things in the course of our class today. Please don't forget that during the course of this class, if you have any question, you can always leave me a question or a chat in the Q&A section of this meeting, and I will attend to it as best as I can. So very quickly, let's jump right into it. The Australian dollar. The Australian dollar is one of the high beta currencies. By high beta, I mean currencies with high volatility or high risk. That is a high risk sensitivity. That's the word I want to use, right? Typically, it responds positively when you have a positive market environment. That is, when the market environment is positive, when you have risk positivity in the market, risk on in the market, the AUD is one of the go-to currencies that traders buy because it tends to appreciate and do well when the global economy is doing well or when the market environment is positive. On the other hand, when the market environment is negative, when you have a negative condition in the market, risk off, negative risk sentiment, right? The AUD tends to lose value as one of the most, right, among the major currencies. I already mentioned that it is a part of the major currencies, and today we're going to look at three main parts of this, right? The facts about the Australian dollar, which we're going to discuss, which helps us, right, form a part of our trading as well. And then we're going to talk about, key factors that influence the price, that influence the price. We'll discuss that and we'll talk about just a few economic significance about the country, about the currency that plays into our trade. Remember, the major idea here is we want to make a profit. That's the idea, right? In trading, we want to make a profit. We do not want to just jump in and out of the market without, clearly understanding what we are doing. In trying to make a profit, it means that we must correctly predict where price is likely to go. That is, if I'm going to trade a currency like the Australian dollar or like whatever, let's say the Australian dollar, for example, I need to know if I should buy it or sell it because by making the wrong decision, I could be making a loss. I will be making a loss. If I buy the Australian dollar and the value starts falling, I'll be making a loss. If I sell the Australian dollar and the price starts rising, I'll be making a loss. So I must be able to determine where price is likely to go based on analysis and information. Now, part of the analysis and information involve these certain factors that we're about to look into. By understanding the facts around this currency, by understanding the factors that influence the price, we can better make decisions in our trading. Number one fact that you want to know is the Australian dollar is one of the commodity currencies. It is dependent on commodities. Australia is big on commodities. They are well endowed with commodities like natural gas, like gold. But most importantly, one of the major currencies that dominates their exports is iron ore. About 31% of Australia's exports is iron ore. And that is important because if the country makes, money or depends a lot on its exports, an export-based economy, and they depend a lot on, or their total exports is 30% iron ore. Whatever happens to iron ore has a major factor or influence on the country's finances, that's the country's income from its exports, and even the country's currency, because the demand for iron ore will also increase the demand, or the higher the demand for iron ore, the higher the demand for the Australian dollar to buy it from Australia. Remember, for you to buy a country's product, you need the country's currency to buy its product. So commodity dependent for the Australian dollar, mostly for iron ore, and you also have coal. You also have coal, another major export of in Australia. Now, whatever happens to this product, now these are not the only product. You have natural gas, you have gold, right? There's so many other ones, but because you have the currency dependent on these particular commodities, significant changes in commodity prices right now, that could be as a result of supply and demand factors, could be as a result of geopolitical development, whatever the case is, whatever affects these assets can by extension affect the value of the currency. There is a positive correlation between commodities like iron ore, commodities like coal, and the currency Australian dollar. The higher the demand or higher the price of iron ore, the higher the price you should expect from the Australian dollar. When iron ore prices start to fall and crash, then you can expect the same to happen to a product like, to a currency like the Australian. That's just one of them. Another thing is, you see, when Australia exports a big chunk of its iron ore, right, China buys almost all of it. About 40% of Australia's exports, now not just on iron ore, goes to China. So that means that whatever happens to China also has its own role or influence on the Australia's economy and by extension the Australian currency. Think of China as Australia's biggest client. That buys a big chunk, about 40% of the country's exports. Of course, if there are big challenges with your biggest client as a person, as a business person, that would have its effect on your numbers. You have a series of clients, but there's one particular one that buys 40% of your whatever you have. So you have 10 items for sale, the guy buys 4 without question. Of course, if he's not able to buy those 4 for whatever the reason is, that has its effect on you. So China has its role as well in terms of influence on the currency. So if you're a trader, you want to trade the Australian dollar, you want to focus on things like iron ore, whatever is happening to the iron ore space. How do you know? Of course, through research platforms, we have a lot of them on our website, the likes of investing.com, the likes of realtors, the likes of Bloomberg. You have so many of them, but they as well have columns on commodities that you can understand what is going on with these commodities per time. And not just that, you want to also be familiar with what's going on with China. When you have positive developments in China where they're looking to say, or the Chinese economy is growing massively, right? That in itself is a good input for the currency. That also supports the Australian dollar by extension. If you have factors that say, oh, we have negative developments in China, maybe a property sector crisis or a major trade crisis, right? Of course, that would also affect or impact the Australian dollar negatively. So as a trader, you want to also pay attention to the developments in China because of their trade relationship. Good news for China positively influences the Australian dollar. Bad news for China, the currency particularly, also negatively influences the Australian dollar. Another thing you want to also pay attention to is the characteristic or the properties of the said currency. Of all the major currencies, you have about, based on risk sentiment, you can classify them in 5. In 2 rather. The high beta currency, which are currencies that have high sensitivity to risk. And then you have the safe haven currency. Now, among the high beta currencies, you have the Canadian dollar, the New Zealand dollar, the Australian dollar, and so on. The Australian dollar has the highest beta. That is, it is the most sensitive to risk sentiment. When you have clear risk on in the market, AUD is the go-to currency, is the currency you want to buy, is the currency that rises the most. When you have clear risk of negative sentiment in the market, AUD is the currency you expect to fall the most. So because of its high risk sensitivity as well, it becomes clearer for traders to also take advantage of it. Now, in a case where you have clearly established clear risk off in the market, AUD is a currency you can sell. When you have clear risk on in the market, AUD is a currency you can buy. Now, if you're here, you don't know what we mean by, risk on or risk off. You can catch the HFM Nigeria's foundation courses. It runs Mondays to Wednesdays online, typically around 3 p.m. You can catch that as well, or you just check through our YouTube handle, HFM Nigeria, and then you can find a video that we have done on sentiment in the past, right? But this is also a key fact you want to be aware of, right? If it's clear risk on and it's happening globally, it's not tied to a particular currency per se, you can expect AUD to react the most positively. But if it's clear risk off, you can obviously expect the AUD to react the most negative. Another thing I want to also mention is AUD is a pro-cyclical currency. What do I mean by pro-cyclical currency? Pro-cyclical currency refers to a currency's ability to positively correlate with the global economy. Let's say it like that in a very simple way. That is, when the global economy is improving significantly, currencies that are pro-cyclical respond positively to that. When the global economy is suffering, shrinking heavily, significantly, currencies that are pro-cyclical, like the Australian dollar, suffers in line with that. Because a currency like this, because of their trade exposure, their exposure to international trade, they enjoy great economic conditions in the global economy, and they suffer from bad or negative economic developments in the global economy. So it's something you want to also pay attention to. So you have reports like IMF saying the global economy should grow at a massive pace, or World Bank releasing reports that, oh, the global economy is doing well, or you have global economic data across major economies printing positive numbers. You expect the AUD to benefit positively from that and rise. As a trader, buying such a currency in such periods would not be a bad idea. So I hope this makes sense. So some of the facts, I don't want to go into the country, facts about the country, where it's situated, the culture and stuff like that. No, we're not looking into all of that in terms of trading. We're just mentioning some facts about the currency. So that when you want to trade the Australian dollar, you must know that it is affected by commodity price. It's dependent, on commodities. It's influenced by commodity development, particularly iron ore and coal. You want to also know that it's influenced as well by developments in China because of the trade relationship. China can be seen as Australia's biggest client. So whatever good things happen with China positively influences the Australian dollar. Whatever bad things or negative development comes up in China negatively impacts the Australian dollar. You must also know that it has the highest beta, a very high sensitivity to risk. When you have positive sentiment, AUD rises or should rise the most. When you have negative sentiment, AUD should fall the most. Right. I'm just going to move into the other part that says, oh, pro-cyclical. It means that when you have positive developments globally, right, in terms of the global sentiment in the market, the global economy, of course, you expect, AUD to respond positively to how the global economy is behaving. That's what I mean by pro-cyclical. That is, the global economy is doing well, AUD should also do well. Or the global economy is suffering, AUD should also suffer. So you have that. Now we're moving to the next segment that says the key factors that influence the Australian dollar. I've mentioned a few facts, but let's just go into it a little bit more. I said under the commodity price, right? I've mentioned this before, but let me say this again. Under the commodity prices, I mentioned commodities like, iron ore, mostly coal. Of course, you have other ones too, like gold. Yeah, gold. You also have natural gas. I saw somewhere as well, oil, right? But maybe not to a large extent. But you have all of these things. Now, because it's a major exporter of these commodities, significant changes in the price of these commodities affects the said currency. Of course, correlation is not 100%, right? It does not mean that every time the moment iron ore moves up 1 pip, AUD must move up 1 pip. Not necessary. It has a strong correlation, but it's not 100%, right? There are times when the correlation may not be strong enough, but it's obviously something you want to consider if you're looking at trading a currency like the Australian dollar. I hope this makes sense, right? All right. Now, the next thing I want to talk about is interest rates. Now, you see, the central bank in Australia is the Reserve Bank of Australia, short RBA. Now, of course, central bank decisions are very, very important when it comes to trading because they form a major part and influence currencies almost the most, not even almost. Of course, whatever the central bank does with policy has a major impact on the value of the currency. And in this case, for Australia, the Reserve Bank of Australia is the one we need to look out for. They usually have their meeting every month, except in January, usually, right? But you see, our focus for this today is our focus for today is their interest rates. When central banks are in a hiking circle, that is, they're looking to increase interest rates, they are already increasing interest rates, or they're planning to keep increasing interest rates, that is usually a positive influence. So that usually has a positive effect on the value of the currency. That is, when central banks are in high interest rate environment, the value of the currency tends to appreciate in line with that. In line with that. On the other hand, when central banks are in cutting circles, cutting interest rates or reducing interest rates, right, the value of the currency tends to fall. Not just after they have started doing it, the moment they start to plan to do it, the moment they start to become vocal about their willingness to do it, it starts to affect the currency as well. And in this case, we want to pay attention to what the RBA does. Now, Australia or the Reserve Bank of Australia are very, 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 very keen on curbing inflation, usually. And as such, they pay a lot of attention to their interest rate, and they're usually in a higher interest rate environment. Barring any major development globally, usually find that Australia tends to have a high interest rate. Currently, they have one of the highest in the market as well, around 5 point something percent. Now, that means that naturally the AUD would gain value naturally against a currency with a lower interest rate. I pick an example, two examples. Currencies like the Japanese yen, even though they're starting to change, the BOJ, the Bank of Japan, are starting to change their current stance on policies, they've increased rates once, right? Maybe even twice now, and they're looking to, there's already talk that they could do it more in the current space that we are here in 2024. But ideally, Japan has been known for low interest rates over the years. Currencies like Switzerland as well have also had mostly low interest rates. Now, because of Australia's, interest rate differential compared to something like Japan or Swiss franc, right? Ideally, you would expect the Australian dollar over time to appreciate in value because of higher demand for the currency to benefit from the higher interest environment compared to something like Japan or Switzerland. And it has been a major candidate for what we call a carry trade. Carry trade is a strategy in the market where traders buy currencies with higher interest rates and sell off currencies with lower interest rates. So buying something like AUD versus JPY, if you have AUD having a high interest rate and JPY having a low interest rate, mostly even negative in this case, you expect that pair to move higher over time. This can be a trade idea. This can be, something that traders pay attention to. Of course, it's a long-term trade idea, but eventually, currencies with a higher interest rate tend to appreciate against currencies with lower interest rates. Right? So it has been, a major, go-to when it comes to carry trade opportunities. Like I said, carry trade is simply a strategy that involves you buying a currency with a higher interest rate and selling the one with a lower interest rate. Buying something like the Australian dollar because they typically have a higher interest rate mostly, and then selling off something like the Japanese yen. So buying a long position in AUD JPY can be what we call an example of a carry trade. Now, but this is a long-term trade idea, and there are obviously other factors to consider like timing, technical analysis, current sentiment, and future outlook. So there's that. Now, the third part here I want to talk about is the trade relation. I mentioned already that you look at Australia, it was a very, China is really, really taking most of that now, but Australia used to be a very favorable place, right, for investors when they're looking to go to Asia. Talk about little intervention in the currency market, stable economy, stable government, right? Stable currency, higher interest rate environment, right? It used to be a very, very major, hotspot for investors looking to go into Asia. Of course, China is taking a whole lot of that now, but the center, of Australia's trade relationship, even there in Asia and across other parts of the world, also positions it as a major, major interesting spot for traders when it comes to the currency. Their major trading partner, first of all, is China by a large margin. But then you have currencies or countries in Asia like Japan, South Korea, and even some other current countries too, also taking advantage. Even New Zealand too, as well. Also, being major trading partners with Australia. So, of course, whatever goes on in this country, but China particularly, but economic changes in these countries influences the currency. China, most importantly. New Zealand also has a major dependence on Australia itself. So whatever happens to China affects Australia, and by extension, you can get some from New Zealand too. So there's that you want to pay attention to. Now, I already mentioned the high risk sensitivity when it comes to the AUD. The AUD is considered, or the Aussie is considered a high risk sensitive currency, often moving in response to global economic stability, investor sentiment in the markets. However, traders are feeling the markets, risk sentiment, investor sentiment, risk on, risk off affects the currency. Right? And of course, you have cases of risk off also negatively influences the currency. Now, by understanding the factors that influence a currency like the Australian dollar, it can also put at the back of your mind, or it can also stay at the back of your mind when you're doing research. So when you're doing research, you're trying to do your analysis before you place a trade, and you're seeing information relating to Australia or China or iron ore or coal, right? Or the central bank, the RBA, or interest rate decisions or policies, right? These factors are things you should consider. You should not just trade the Australian dollar blindly without paying attention to these factors. Are we on the same page? All right. Now, having known these things, the technical side of it, the technical side of trading the Australian dollar is not different from every other asset. It's not different from any other asset, right? The same way you apply technical analysis, like, technical indicators, chart patterns, um, support and resistance, right? Candlestick formations, whatever it is that you use, the same way you apply these tools to every other asset, you can also apply it to AUD pairs. For me, my go-to when it comes to trading the Australian dollar is pairing it against something like the US dollar, but most importantly, the Japanese yen. And that is because if you look at an example of Japanese yen and the Australian dollar, they have opposite dealings mostly. Whatever goes on with Australia, whatever affects Australia almost has a negative impact on Japan, right? When you're talking about high interest rate environments, AUD has a higher interest rate environment. Japan has a low interest rate environment. When you talk about risk sensitivity, AUD is a high beta currency, one of the highest beta when it comes to currencies, right? JPY is one of the one that has the lowest beta, right? A safe haven. So you have that opposite reactions. So that means that when you pair them together, in most cases, they move opposite to each other. When you have risk off in the market, when trader sentiment is negative, you have risk off in the market. AUD tends to fall massively while JPY tends to rise in that condition. And when you have risk on, AUD tends to rise massively and JPY tends to fall massively under that condition, right? So, I mean, you look at these factors and you notice that, oh, that pair, AUD, JPY, you look at it over the years when it's moving clearly. So that means that, you know, tools like the moving average would be a very interesting, tool to apply when you trade something like AUD, JPY, for example. Of course, there are other factors to consider, but I'm just mentioning things like support and resistance, trend lines, right? Because the trends are usually clear when the market environment picks a narrative and runs with it. The last part of this I want to talk before we go into, I'm discussing is economic significance. Now, I mentioned this already in the course of my, my session, but the economy in Australia is stable, one of the major economies, and stability has also been one of the major things that has helped the currency over the years. Of course, the US economy takes, takes the lead in this, but of course, you can also rely on the stability of the Australian economy as traders, as investors. So you can expect that if the economy is doing well, the numbers are showing, we can expect that trend to continue. And as traders, we want to take advantage of that too, because it affects the currency positively. Don't forget, I already mentioned that it's a pro-cyclical currency, which means that it responds positively to the global economy. When the global economy is doing well, it follows suit. When it's suffering, it also suffers as well. When I say strong government, I would also like to say it as stable government. Australia has that. You'd rarely see stories about, the way you have it in UK, where the prime minister is changing like every other day, literally, right? I mean, if you start to count from Cameroon, I mean, you had so many people after that. We've had Theresa May, we've had Boris Johnson. After we had a lady, I've forgotten her name now, right? We had one, then we had Sunak, Rishi Sunak. Now we have a new person as well. I mean, in the UK, we always have on instability when it comes to their own government, right? Prime minister changes like water. But in Australia, it tends to be more reliable. That means that policies are usually more stable. You can expect that. Yeah, I think I remember. I think it's Liz Truss. That's the prime minister I was trying to remember. Liz Truss, just before Rishi Sunak, and then before um, the current guy that we have there. I don't think his name has stuck yet. Right. So you have that. And then the Reserve Bank of Australia is also, a central bank that you can expect transparency from, right? They do not, I won't say they don't, but they rarely intervene in their currency. The currency flows purely based on demand and supply most of the time, at least according to what we can see. Um, the RBA does not secretly intervene in the currency. For countries like, China, we know they mostly intervene. It's obvious they do. They intervene in the value of the currency to stem a massive or volatile movement, either positively or negatively, in the currency. Switzerland also pays attention to that as well. Right. So there's that. But in Australia, we don't expect that to happen. It doesn't happen as often. You don't, I've not seen that in recent time, right? But I don't want to say it never happens. But of course, that's a major, major influence. So that means that whatever the RBA says, traders can take that and hold it and run with it, right? If they're doing something, they let us know, which is also a major part of this. And then you also have the high interest rate environment. I mentioned that already. So because of that high interest rate environment, you can also expect that, the currency tends to appreciate most of the time. Most of the time, generally, overall, it tends to mostly be on an uptrend because, high interest rate environment attracts investors. In the carry trade environment, in carry trade example, investors can go to countries with low interest rate like Japan, borrow money at low rate, right? Bring it to countries like Australia and invest to earn or benefit from the higher interest rate environment. So there's that. Now, if you cross over to the charts, right, I just want to look at it and just show you a little bit of, history and what it's looked like when it comes to currency pairs like AUD over the years, like over recent time. Let me just show you that. Now, this is the pair AUD right? I've gone to the daily time frame so we can just scroll back and look. Now, of course, over the last, I think from July, really, we've had a change in the stance of the Bank of Japan where they increased interest rates and then they've started to, look into that more. And that's why we've had that massive downturn. You can see the trend is usually very clean. Before then, when we had the uptrend, it was clear, right? We had cases where the pair kept moving higher, clearly, right? So the trend has always been clear. When it moves lower, there must have been a reason for this at the time. I can't remember now, right? But then you have that, right? When you usually the trend you look at is usually clear. There's usually less times when you have just a pure range for too long a time. The trends are usually clear. If it's moving higher, it's clearly moving higher. If it's moving lower, it's clearly moving lower, right? Moving higher, clearly, lower, clearly, higher, clearly. And that's how it's been over the years, really. Right. So that's why this is one of my favorite pairs to trade because most of the time it reacts very clearly in line with what is going on in the market. The both currencies tend to react opposite to different developments. So it offers a good opportunity to trade, right? As traders in the market. So, I mean, the things that we've mentioned, like I said, when it comes to the technical side of things, of course, you want to look at different things, right? Different technical tools. This class or this session is not focused on technical tools. But of course, if you look at simple tools like moving averages, simple tools like support and resistance, simple tools, like even chart patterns, right? I mean, they can give you good entry signals on assets like this. I hope that makes sense. Now, I see that some of us already have questions. I'm going to run through the questions very briefly before our time is fast spent. At this point, remember I already mentioned that the Q&A section of the chat is open. So that means that if you have a question, you can always reach out to me and I would attend to your question. So please do that while I attend to the ones that are already pending. Now let's go. I have a question from okay, not so much questions yet. So please let the questions come in. Just a couple of confirmations that you can hear me loud and clear. I think I'll answer this as well. Now, this one says sometimes you can follow all of this and use your technical analysis and still hit a stop loss. What is a stop loss? Of course, that's a level where you're limiting your losses. That is, if price gets to that level, it closes out your trade and your loss is limited to that amount you had already pre-specified. But is it possible for you to go through the information, go through your technical analysis, and still have trades hit your stop loss? Yes, it's possible. The idea behind analysis is not to eliminate the possibility of a loss, is to reduce the probability of it happening. The idea behind analysis is not to eliminate the possibility of taking a loss in the market. You can't eliminate that. You're a speculator. Losses are always going to be a part of what you're doing. But it helps reduce the possibility and reduce the probability of it occurring. So when you do your analysis, right, you do your analysis, you do your fundamental analysis, understand what is driving an asset, and then you do your technical analysis as well. It increases the probability that you're correct. It means that you're most likely to be correct on that trade, or most of the time you'll be correct when you take trades based on that. But you still have to understand that it does not eliminate the possibility that you can be wrong. So stop losses are key. Now, your entry is also important because if you do not enter properly, if your technical analysis are not on point, and of course, you may also struggle with that. Aside from that, if you do not place your stop losses properly, where you put it too close to price, or you do not factor in price oscillations, of course, swing points in price, of course, you could easily get knocked out on your stop loss. But I mean, what's the other alternative here? You cannot do without them. They help you increase your possibility of being correct, right? This one says, you're a bit fast. Can we get the link to the recordings through our emails? All right, apologies for being fast. I would have loved you to have said that at the time that it was happening so that I would have, taken note and maybe reduce the pace of what I was saying or even repeat that. But the recording will be posted on the HFM YouTube, HFM Nigeria YouTube handle. So please, later on, later today or going into the weekend, Monday, you can as well just go on YouTube, search for HFM Nigeria, and then you'll find the recording there. It's going to be titled Trading the Australian Dollar. And then you can catch that, copy the link, watch it, and then do whatever it is that you want to do with that. All right. Why is China currency not a major currency when it comes to FX trading? Well, now, one of the things that you could see or you could say is, quote and unquote, it's said that you can trust the central banks of the major economies. Now, how true that is, I can't say for a fact, but it's just one of the major themes that you have or sentiments that you have out there in the market. That when major central banks do something, they tell you, when they plan to do something, they tell you, right? And they tend to follow through with it. But the Chinese government can, intervene in the currency mostly and not tell us it's done. That's according to markets. The Japan central bank also intervenes. So that kind of counters what I just said. But it's a theme in the market, it's a sentiment in the market. And I can't say for sure why it is, another reason why I would want to target as major in that sense, aside from the one I just mentioned. But when it comes to also trading volumes as well, right? Of course, you have more trading volumes run through the major currencies compared to exotic currencies like the Chinese yuan. So you have that. I hope that answers your question. All right, good afternoon, Mr. Badmos. This one says, Sir, how do I know the market sentiment each day? I find it so hard to know the market sentiment for time. And if it changes, I don't know as well. Please help me clarify. All right, thank you for your question. Now, market sentiment is something we can pay attention to. It helps us also find trading opportunities in the market, right? One of the ways to find it is through market research and analysis. Through the HFM Foundation course, we go through that in full. So you can please try to catch that Mondays to Wednesdays, 3 p.m. online. The links will be with your account managers. Those that have accounts to HFM have account managers, so you can catch that. Um, that's one thing. Now, how do you know the sentiment? By running through what's going on. What can influence the sentiment? Development in the market. Good news typically calls for positive sentiment in the market, and that influences how assets react under that condition. Now, the way you'd know if the sentiment changes is by paying attention to the initial driver in the first place and the subsequent development as it occurs. By keeping track of the news feed, you can also know what is going on in the market, and it would also help you make better decisions as well. So, one of the ways you can know what the sentiment is each day is through market research. Now, those of us on the HFM Telegram channel, if you're not on there, you can speak to your account managers. They can get you that information. I can also drop the link to my chat. You can as well send me a chat and I can add you to it. Every single day, we let our clients know what the sentiment is per day. We also discuss it in our foundation course, and we also give you tools or resource points where you can also keep track of the new flow as it happens in the market, and you can as well know when sentiment shifts. I hope that answers your question. Um, does HFM trade stock options? When you say stock options, right, we don't trade options as a financial asset in itself because it's also a unique financial asset. What we have are a form of derivatives that we call CFDs. But yes, we have stocks, CFDs on stocks, foreign stocks like US stocks, Euro stocks, Asian stocks, and so on and so forth. You have them. And we also have stock indices as well as CFDs on our platform. So the likes of Tesla, Facebook, that's Meta, Amazon, Alphabet, and so on and so forth. Twitter, Coca-Cola, just mention it. We have it available to trade on our platform. So we have CFDs on stocks that you can also trade on our platform. I hope that answers your question. Now, somebody says here, Mr. Steven says, NZD and the Aussie, that's the Australian dollar, behave alike most times. Does it mean that NZD has same direct influence as AUD to China too? Maybe not as much, but of course it also does. Because one of New Zealand's major trading partners is Australia. So don't forget that whatever happens to China affects Australia and by extension, New Zealand. And when you look at the risk sensitivity, New Zealand also has a high risk sensitivity, not as high as Australia, but also somewhat close. So whatever happens in terms of sentiment affects those two currencies the same way. So you also have that. And then, of course, it's also, a commodity currency, New Zealand as well. In their own case, it's not iron ore and coal, but mostly dairy products. So you also have that sensitivity to global economic development. It's a pro-cyclical currency as well, and as well a commodity-linked currency. So very, 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 very close factors influence both currencies, and that's why you would have them, moving in tandem generally in the market. I hope that makes sense. When I say tandem, I mean in line generally in the market. All right. Why is dollar prefix attached to the Australian dollar if it's not directly linked to the American dollar? Dollar is not just used by the US. Different currencies use dollar as part of the name, right? Even franc is not just linked to Switzerland. Other currencies also use the franc. So examples of currencies that use the dollar, right? Singapore uses dollar, the Singapore dollar. Australia uses dollar as not US in that sense, but as the name of their currency. Um, New Zealand uses dollar, Canada uses dollar, US uses dollar. So the dollar is a name for currency. It now depends on the country you're referring to. Hence, you have them have the names. So you have the American dollar, the US dollar, referring to the dollar that comes from the US. We have the Australian dollar referring to the currency in Australia. We have Singapore dollar referring to the currency in Singapore. All right. How do I place my entry rightly after doing my analysis, especially when prices moved for a while? Now, this is not the class for technical analysis. Please try to catch the foundation course or one of the videos that we have done on our HFM Telegram, HFM YouTube handle to catch this. There are different ways that you can find entries, the different tools you can use. I mentioned earlier indicators, I mentioned earlier support and resistance, price action, right? I mentioned earlier chart patterns. So it now depends on what you're looking for, but we don't have all the data to look into all of that right now, right? You can as well um, catch the class, the foundation course, and then you can run through that, okay? This one says, does HFM trade volatility pairs? When you say volatility pairs, I want to assume you're referring to volatility indices. We have one. We have the US dollar index and we have the fear index. The fear index is the volatility index for the stock markets. It's called the VIX.F on our platform. So we have that. We don't have other volatility indices, right? But we have the VIX. That's the S&P or the US 500 fear index. So we have that. That's the one we have on our platform. Um, Let me see. I think I have. Let me quickly get the link to my chat. There's some questions here that someone asked about stock options, and just please look at this. All right. So let me just get you this. Let me chat. All right. So there you go. Um. All right. So there you go. Now, just quickly attend to the last ones that we have before we call it a day. Um. Please, which indicator is best suitable for AUD pairs? And can you share how to set it up on the metaphor? Now, we can't do that in this particular class. This is not the webinar for that. You can always try to catch the foundation course, like I mentioned, the technical analysis class, like I mentioned, and then you can run that, how to set it up. The foundation class runs Mondays to Wednesdays. It starts at 3 p.m. online. So we go through how to use the MetaTrader platform, how to set it up, how to place trades. We're going to how to find the trades, technical analysis, and all sorts, right, in that particular class, right? Um, does HFM trade stock options? Can I get someone to discuss this with, right? I've sent the link to my chat, I think to you privately, but let me see if I can also send it to the entire group. So if you have a question for me outside what we have, I'm going to send the link to my chat, right, in the chat box now. So you can send me a chat right there on Telegram and I can attend to it. So there you go. You can send me a chat and I can look into that with you. All right. So I'm going to wrap up the recording at this point, and then I want to say thank you to everyone for joining me in this particular session. I hope to see you other times in other sections, and then or other sessions rather. We have webinars that run on Fridays, usually on Fridays, so you can always catch up with your account managers, and then you can always, you know, follow through, and then we can see how to help you get better, improve in your trading. All right. I'll say thank you everybody for that particular one. I'll catch you some other time.